There is a number sitting in the stock market right now that has only appeared once in over 140 years of recorded US financial history, and the last time it showed up, the market crashed and took more than a decade to recover. That number is here again right now in 2026, and most people have absolutely no idea. Look, the S&P 500 has done something remarkable over the past 3 years. It went up double digits in 2023, double digits in 2024, and then again in 2025, delivering a total return of nearly 18%. 3 straight years of massive gains. 3 years in a row where anyone who just stayed invested made a lot of money. And right now, the Dow Jones just hit all-time highs, closing above 50,000 points. The market feels unstoppable. But here is what nobody is really talking about. The situation underneath those gains is unlike anything this market has seen before. Not in the 2008 crash era, not in the dot-com bubble, not ever. And to understand what is actually going on here, we need to go through 3 specific things happening right now. And by the time we get to the third one, I think you are going to see this market in a very different way. So leave a like and let's start with the number I mentioned at the beginning. Because this is where it gets real. There is a metric called the CAPE ratio. It stands for Cyclically Adjusted Price to Earnings. It was developed by Nobel Prize-winning economist Robert Shiller. And what it does is look at how expensive the market is compared to the actual earnings companies have produced over the last 10 years, adjusted for inflation. It is not looking at one single year, which can be distorted by a good quarter or a lucky moment. It is looking at a full decade of real earnings versus what you are paying today. It is basically asking, how much are you paying for $1 of real profit? The long-run average going all the way back to 1881 is around 17. That is the normal. That is what the market tends to return to over time. Right now in May 2026, the CAPE ratio is sitting at approximately 41.6. That is more than twice the historical average, and it is the second highest reading ever recorded in over 140 years of US market data. The only time it was higher was in December 1999, right before the dot-com crash. Before that, the only other time it came close was the late 1920s, right before the Great Depression. So let that sit for a second. There have been 2 periods in modern history where this metric reached these levels. Both of them were followed by catastrophic market corrections. Now, does that mean a crash is coming tomorrow? No. A high CAPE ratio does not predict when something happens. It does not work like that. But what it does predict, with a strong historical track record, is that the next 10 years of returns from this level are likely to be much lower than what we have seen in the past 3. And that matters enormously if you are planning your financial future. But here is where it gets more complicated, because the CAPE ratio alone does not explain the full picture. To understand why this market is truly unlike anything we have seen before, you need to understand the story of 7 companies. You've probably heard the term Magnificent Seven: Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla. These 7 companies have become the engine of the entire US stock market, and the degree to which they dominate everything is now at a historically extreme level. As of April 2026, these 7 companies make up approximately 33.7% of the entire S&P 500, 1/3 of the entire index. In 2016, that same group made up only 12.5%, so in about a decade, their share of the market more than doubled. And in 2025 alone, they were responsible for 42% of the index's total return. That means if you had taken those 7 out, the rest of the 493 companies in the index would have barely moved the needle. Think about what that actually means. When you put money into an index fund, which is what most people do, and for good reason, you are not really buying 500 companies equally. You are putting a huge chunk of your money into 7 companies. That is not diversification. That is concentration dressed up as diversification. And the top 10 companies by market cap now account for 40% of the entire S&P 500. That is a record concentration level. It has never been this high. Now here is the part that makes this interesting. Are these bad companies? No, absolutely not. Apple, Microsoft, Nvidia, these are genuinely extraordinary businesses. Their profit margins are real, their revenue is real. This is not like the dot-com era where you had companies with no revenue trading at absurd prices. Nvidia, for example, is trading at around 24 to 26 times its expected future earnings. Compare that to Cisco in the year 2000, which was trading at 472 times earnings at its peak. So structurally, it is not the same situation. But here is the problem. The market has started to price these companies as if everything will go perfectly, as if AI spending keeps growing forever. as if no new competitor shows up, as if interest rates never cause pain. And when everyone is betting on the same 7 horses, the market becomes very fragile. Because if even one of those bets starts to crack, the ripple effect across the entire index is massive. 7 large technology companies invested approximately $437 billion in capital in 2025. That is 61% more than they spent in 2024. And it is nearly 2.5 times what they spent in 2023. The AI build-out is not a small side project. It is the biggest capital spending cycle we have seen in a generation. And according to Fidelity Research, roughly 60% of GDP growth right now is being driven by this AI build-out. That sounds like a great story. And in many ways it is, but it also means the economy and the stock market has become deeply dependent on one single theme. And the question nobody can answer with certainty is, what happens when companies spending $400 billion a year on AI infrastructure need to start showing a real return on that investment? Because right now, there is a gap, a clear and growing gap, between the amount being spent on building AI and the amount being made from actually using it. AI infrastructure is being built at a historic pace, but the actual revenue that most companies are generating from AI tools and services has not caught up yet. Some analysts describe this as the difference between the builders and the monetizers. And the builders are getting a lot of the investment money right now, even when the returns are still unclear.